Trading earnings can be tricky. Sometimes a company can beat earnings and still drop, or vice versa. Today, I'm going to share one of my favorite strategies for successfully trading earnings. Hello and welcome back. I'm Dr. B with Ready, Set, Grow. On this channel, my goal is to share tips to help you on your financial and trading journey. If you're new here, like and subscribe. Leave a comment below saying you subscribed for a chance to enter our next giveaway. Also check the description for some valuable resources. Be sure to watch to the very end to see if you're one of our winners selected in today's giveaway. Before I tell you the strategies I use now, let me tell you what strategies I used in the past that didn't work. In the past, I would check to see if the company was expected to beat earnings or miss earnings, and then I would do my own due diligence and additional research to confirm the prediction. Once I had an idea of whether or not the company was going to beat or miss earnings, I would simply buy a call if I thought they were going to beat earnings, or I would buy a put if I thought they were going to miss earnings, and then I would hold it until after the earnings report. This method worked about 50% of the time, leaving me with really big wins and some really great losses. We all know that trading earnings is unpredictable and extremely risky because a stock can beat earnings and still open lower and tank, or a stock can miss earnings and spike. So it's very difficult to just predict a direction. Instead of predicting one direction, I trade earnings using a straddle or a strangle. This is a neutral strategy that allows the trader to capitalize on the movement that occurs after the stock reports earnings. This could be a big move up or a big move down. A straddle is buying a call and a put with the same strike and same expiration. A strangle is buying a call and a put with the same expiration but different strikes. This strategy is more about the magnitude of the move in any direction versus choosing the right direction. And how this works is, for example, if a company beats earnings and for some reason it opens up $10 more the next day, then the profits from my call options will likely offset my losses from the put option. Okay, let me walk you through how you would buy a straddle and how you would buy a strangle. Right here I am in my TD Ameritrade account. As you can see, I'm already in Tesla long term. I can still go ahead and show you how to open a straddle and a strangle on this ticker. A straddle is buying the same strike and same expiration. So I'm looking at the October 1st expiration and I'm usually getting at the money. So let's say I'm going to get this 740 at the money contract. I'll go ahead and place the order for an at the money call contract. Once I've confirmed and sent this order in and it gets filled, I go ahead and get the same contract on the put side. So a 740 strike, and I'm getting the same contract regardless of the price. Placing the order, confirm it's in, and once you're filled, then you will have opened a straddle. The same thing for a strangle. The only difference is I'm getting different strike prices. So for the strangle, if I wanted to get this 735 call, then I would go ahead, place the order for the 735 call, confirm and send. Once I'm filled on the call position, I look for a put position that doesn't have the same strike price. Since I only trade at the money or in the money contracts, I will go ahead and get the 740. So that's a 740 strike, click on the ask and place my order. Then I would have opened a strangle on this ticker. You can easily identify what companies have earnings by looking at Yahoo Finance, or you can come over here in TD Ameritrade and pull up one of their watch lists that show you the scheduled earnings. If you go to public R through W, you can find who has scheduled earnings within the next 5 days. So I would open an in the money or at the money call and put as my earnings play. And I'm getting the same number of contracts. So if I got one call, then I'm going to get one put. And for the expiration date, I usually get a contract that expires after earnings happens. So if earnings happens on a Wednesday, then I'm getting the same week expiration that would expire on Friday. Now, most of the time when I'm in a straddle or strangle for earnings, I would see that my strangle or straddle is already green before the earnings report. And this is where I have to make a decision. Am I happy with the profits that I already have? And if the profits are significant enough, I might go ahead and close it and not hold it through earnings. If I'm not satisfied with the profits and I'm willing to take that risk, then I go ahead and hold through earnings and close after the earnings report. If I'm holding through earnings and I'm closing the day after the earnings report is released, I like to wait to see how the stock opens. Once you see how the stock opens, you can close your losing trade. So let's say it beat earnings and it shot up. Well, your put is going to already be red, so you will go ahead and close your put and let your runner run. I hold on to the winning position until I see that momentum is drying up, and then I will go ahead and close it. Here is an example of a strangle that I am in for FedEx, which has earnings Tuesday after market. I was already green on this trade, but I decided to hold through earnings. For FedEx, I have the 255 put and a 257.5 call. That is a strangle. My put is up 27% and my call is down 34%, leaving me with a negative $14.50 right now. After the earnings report is released, I'm going to see which one of these contracts moves significantly higher and go ahead and close the losing contract and let the winning contract run. I also have a straddle on Nike, which has earnings on Thursday after the market closes. I have a 155 put and I have a 157.5 call. I have one of each and I'm up about $52, 6% for now. My put is up $147.50 and my call is down $95. Again, depending on how the stock moves after the earnings report, one of these is going to go significantly higher. As long as the contract that runs is higher than the contract that loses, I will be able to close this green. I use this strategy for 6 other earnings plays and I close all 6 of them green. It's important to note that this strategy works best on larger cap stocks that tend to have higher daily average true ranges. This would not work on penny stocks or small cap stocks since they don't tend to make that much of a big move or they don't really make large moves after earnings. For this month's giveaway, I'm going to be selecting 3 winners. If your name is selected, contact me on my website, optionsqueen.org. Select the email icon and send me a message to claim your prize. Our first winner is April Joy Mack. Contact me on my website to claim your prize. Free World, you are our second winner. Congratulations. Contact me on my website to claim your prize. Andreas Ricardo, you are our last and final winner. Contact me on my website to claim your prize. If you have not won yet, no worries. I'm going to be doing more videos and more giveaways, so hang tight and just keep watching. Thank you all for your time, and I hope you found something in this video that's useful to your trading. See you next time.